Hey guys, Josh and Aaron back for another Finance Friday, and if you're a business owner, you're going to want to listen to this. We are going to discuss owner-occupied commercial industrial financing, how you can take advantage of some of the products and services out there right now, and what you need to know about qualifying for this kind of stuff. There isn't a ton of information in the market about it, and a lot of the lenders who do lend on it, it's pretty lucrative. So let's get into exactly how you go about qualifying for this.
Yeah, so qualifying, the owner-occupied standpoint, similar to like most buildings, we still have to take a look at the income and debt servicing of the overall asset. But there's a more unique approach here which really helps with the qualifying debt servicing depending on the strength of the company. So firstly, we're going to take a look at the building. What is the net operating income? How much mortgage are you able to debt service? Your debt servicing here is usually a little bit higher, maybe 125, but probably closer to like 123 depending on the lender and the type of product that you're going to be using. So it is a little bit higher than what you'd be getting on the multifamily side. But you also get to take a look at the accompanying business income that's coming with the asset as well too, from an EBITDA approach, and then how much net income after your taxes do you have remaining over to be able to help pump that income back towards the overall debt serviceability of the entire mortgage application. So you're not just getting the strength of the asset, but you're also getting some of that NIT, that net income after tax, to help kick back and strengthen the application overall. And depending on obviously the strengths of the company, if you're holding in a lot of liquidity in your company after the taxes, you can really start to stretch that affordability and that overall borrowing power. And that's huge because a lot of these companies, when we're taking a look at this, larger industrial properties or larger commercial type plazas, they're large square footage, they're big buildings, the dollar value tends to be a little bit higher. So there does need to be a little bit of that extra qualifying power to help boost that application.
Yeah, and odds are when you're in growth phase of your company, if you're always looking to get a bigger size unit, you're going to have to be stretching your balance sheet. You're going to have to be trying to find ways to be able to get the net income to be able to qualify. And that kind of brings us to our favorite part of being a broker, is just like we have a handful of different options available to you in Canada that you can use depending on where you're at in your business cycle. If you're brand new and you're looking to grow, if you're established and you're looking to get in a bigger spot, or if you have multiple different chains and you're looking just to expand those owner-occupied chains. One of the things to keep in mind really is that your operating statement or your financial statements that you provide to us, we can add a handful of things back into your net income. So if you're at a place currently and you're renting that place, we can take 100% of that rent and we can add it back to your income because it's going to go towards servicing the new mortgage that you're looking to take on. Amortization on equipment, a lot of the times if you're an operating business and you provide a service or you have large equipment, a lot of times you'll try to amortize that and take advantage of paying less tax over time. We can add that back as well. Any sort of like additional interest costs and things like that. What you can do is you can very quickly increase that net operating income of the operating business itself to take on that new debt servicing. Some of the challenges with newer businesses though is the 2 years of average financial statements. Sometimes when you're looking to grow, you'll have a good year and then you'll have a breakout year, and that breakout year will be phenomenal. You'll be able to go to the bank and you'll be like, I want this bigger building, I want to buy more equipment. You're in growth mode, but you don't have a solid 2-year average is the problem. And some banks will look at that a little bit differently. And there's kind of a few tiers of banks in Canada. There's Business Development Canada, BDC, it's a federally backed, essentially bank. They're their bank, yeah?
It's the CMHC of the commercial side.
Yeah. So they're federally backed and they provide loans that are out of the realm of conventional debt servicing. And they look at things a little bit differently with a little bit more risk for business owners, but also comes at higher prices. They can provide higher loan to value options. They can be a little bit more creative, but you do need at least 2 years financial statements to be able to do that. Alternatively, if BDC isn't your cup of tea and that's not where you want to go, you got the big banks. The big banks, if you're established and you have multiple years of strong financials, you can go and qualify for this type of debt with those banks. Now, challenge being they have higher debt servicing ratios, they probably have higher scrutiny when it comes to credit, and they're going to be a little bit tougher to be able to get those higher loan to value options, which a lot of the times they're going to require you have a larger equity position for those deals. And last but not least, there are some really aggressive alternative lenders in the space as well. They play within the big bank versus like alt A, alt B solution. And what they do is they take a look at your income in your corporation a little bit differently. They're going to be less stringent on 2-year average, and they're going to take a look at your last year's financial statements and be a little bit more aggressive when it comes to the debt servicing. Debt service as low as 1.1. They can use extended amortizations to 30 years, and they can be a little bit more aggressive on the leverage that they can actually provide on these types of assets. Most big banks are roughly around 65%, whereas some of these alternative banks can provide up to 75%. Now, last but not least, there's actually private capital. There's institutional private capital like MIC Capital. And if you're looking to acquire something that maybe has environmental issues and challenges, or you don't necessarily have 2 years of financial statements to be able to continue to grow, this is a good option to provide you multiple years of history of owning the asset to be able to get yourself in a situation where you can then transition into that next level of debt.
And the third, last but not least, is also depending on the industry that you're buying in. If you're getting any sort of like healthcare, medical, dental, but also from like a veterinarian standpoint as well too, there's other government programs that the lenders can tap into to again, like structure more competitive financing. So, they can offer higher loan to values, especially if you're buying the business along with the real estate, like you can get higher loan to values on the sale of the business, on the purchase of the business. Sometimes they'll help offer like operating lines of credit and stuff as well too. Obviously, you do need the financials. If you're buying the business, you do need the financials to help back it. But the healthcare industry, there's a lot of government grants available to help boost up the strength there to be able to, again, just get higher leverage, more aggressive structuring on the sale and the buying.
Yeah, absolutely. It's kind of like how Scotiabank and some of these big 5 banks have specialty programs for like vets and doctors. They have specialty financing for industries that they're looking to help grow, especially, in Canada. And final, last but not least, when you're looking at taking debt on this type of asset, not only are you going to use your personal business income to qualify that debt, the bank is also going to look at how does this building operate if this person no longer rents that building, because it's great that you as a business can qualify for the mortgage payments. That's great. But they also want to take a look at market rent in the area, and they want to see, well, how is this building going to operate? How much debt can this building support at market rent? They'll take a look at bottom end and the low end of that market rent to determine the maximum amount of leverage that you can qualify for as a borrower. And this is really where borrowers start to look at alternative options from the banks, because you could have the best financials in the world but want a higher loan than the maximum loan to value that these banks are going to provide to you, and they're not going to give it to you because the market rent just limits you on the ability to be able to actually take that leverage. Looking at alternative types of debt in this case doesn't necessarily correlate or reflect the actual operations of your business at this level. So when you're looking at buying a smaller property, let's say 10,000 square feet versus 15,000 square feet, and you're looking at the market rent per square foot, the economics behind it all, it makes sense to buy a larger space because it can qualify for more debt than it does a smaller space. So you're in a race that when you're growing your business and you're acquiring this space to grow your business, you almost have to grow at a larger pace to be able to actually have the market rent support the debt you're looking to take on instead of that smaller space. Now, all things to keep in mind when you're looking to scale and purchase this type of asset.
Yeah, guys, obviously a little bit of a different topic today, but something that we're seeing more and more of again are these owner-occupied industrial commercial spaces. A little bit of some different nuances, definitely, again, some cool features that you can get similar to the CMHC stuff. There are some really cool structuring and competitive structurings that you can get on the commercial side. Again, really focusing on businesses that have some operating history. That's really where you're going to get your best strength. So if you own a business, you're looking to expand, you have that stability already in the company, reach out to us. Let's take a look at the numbers and we can try to help point you guys in the right direction.
Yeah, and last but not least, if you did like this video, hit the like button and hit the subscribe button. It allows Aaron and I to shoot more content like this for you. Until next time, take care.